Thought leadership from PwC's National Office.
Remember, one of the elements of key elements of emissions reporting is to show the world to you how you manage, how you impact the reductions of emissions, and impacting reduction of your own direct Scope 1 emissions versus indirect Scope 2 and Scope 3. Those are different ways you can do it, and readers of this information look at it differently. So this classification is really crucial.
Hello, today we're back talking ESG, continuing our mini-series which breaks down the building blocks of greenhouse gas, GHG emissions, reporting. In today's episode, we focus on step 3 of the process, determining the operational boundaries. This is PwC's Accounting Podcast. I'm Heather Horn, and thanks so much for joining us today. In today's episode, we'll cover operational boundaries, what they are, how they're determined, and how they affect the calculation of GHG emissions. Today, I'm joined by Marcin Olewinski, a National Office partner who leads our global technical working group focused on GHG, and Kelsey Pizza, a senior manager in the PwC National Office who also focuses on GHG, and who, together with me and Carolina Cosby, are the lead authors of the GHG reporting chapter of our Global Sustainability Reporting Guide. Whether you're preparing for mandatory regulations or considering voluntary reporting, you'll be sure to find some helpful insights in today's episode. With that, let's continue the conversation with Marcin and Kelsey. Marcin, Kelsey, welcome back to the podcast. And we are reuniting this week to continue our conversation on GHG reporting. And I highly recommend to our listeners that you go check out the first 2 episodes. Step 1 is where we talked about the various regulatory frameworks and understanding what your reporting requirements are. And we talked about that specifically in the context of GHG. And then in last week's episode, we talked about organizational boundaries. And now we are up to step 3, which is determining your operational boundaries. All of that said, I will say, even if you haven't listened to the other 2, this is a standalone episode, as I often say with books. And so you definitely can listen to this one without listening to those other 2. So with all of that said, Kelsey, can you kick us off by explaining exactly what are operational boundaries and how they interact with organizational boundaries? Because I think often people just equate them and assume they're the same thing.
Yeah, absolutely, Heather. So as you mentioned, setting your operational boundaries is our third building block of our emissions reporting. So as you mentioned, first step, determining your reporting obligations. Second step, setting organizational boundaries. And third step, determining operational boundaries. So really setting your organizational boundaries is a distinct step from operational boundaries. In your organizational boundaries, what your company is doing is identifying all the owned or controlled entities and operations that are going to be included in your emissions reporting. Whereas the step 3, determining your operational boundaries, is where the company identifies all sources of emissions within those entities and operations and classifies these sources between direct and indirect emissions. And when we talk about classifying emissions as direct and indirect, we're generally talking about classifying those emissions between Scope 1, 2, and 3, which we'll go into a little bit more detail in a number of our mini-series episodes. But Scope 1 for the viewers it's talking about those direct GHG emissions that occur in owned or controlled entities and assets as well. And then Scope 2 are those indirect emissions associated with the generation of purchased electricity, steam, heating, and cooling. And lastly, Scope 3 are all other indirect emissions within the value chain of the company.
All right. So, Kelsey, I think that's helpful background. And I know for our listeners' benefit, we are going to be having then our next episodes in this series. We'll be talking specifically about Scope 1, Scope 2, and Scope 3 measurements. So I don't want to get into too much detail, but I do think it might be helpful, Marcin, as people are listening to this episode, to give a few examples of what belongs in each of those scopes.
Thank you, Heather. Okay, so let's start with Scope 1. So as Kelsey said, the Scope 1 are direct GHG emissions that occur from sources that are owned or controlled by the company. And that's the most important distinction. So when you talk, what are those sources? Generally, the most common is combustion, right? Combustion of fuel. So we're talking about stationary or mobile combustion. Stationary combustion is, we're talking about fuels that are combusted in fuels such as natural gas, diesel, coal, or gasoline that are combusted in owned or controlled sources like boilers, furnaces, or other equipment, right? Combusting equipment. And mobile, we're talking about simply cars, right? So the fuel is combusted in cars. Those are the most common that probably everybody heard about it, but this is not all. We also have two other sources. One is physical or chemical processing, which we're talking about manufacturing or processing of chemicals or other materials, right? Where it occurs, production of cement, aluminum, waste processing, right? So it's pretty important source practically primarily in industrial companies. And then last but not least, fugitive emissions. So we're talking about intentional or unintentional releases. For example, equipment leaks, methane emissions from coal or pipelines, emissions from air conditionings or coolers. So all these intentional or unintentional releases. So this is the scope 1. Then scope 2, those are indirect emissions associated with generation of purchased electricity, steam, heating, and cooling, which purchased electricity is probably the most common and significant source that everybody's familiar with, right? And last, scope 3. The main thing with scope 3 is those emissions are pretty much the same as a scope 1 and scope 2. They just occur in a value chain of a company, not within the company itself, right? So we're still talking about combustion, processing, and things like this. It just occurs outside of our company in our value chain.
Well, and one thing I think that's an interesting point on purchased electricity and something, just to remind listeners, I'll reiterate the point you made. So scope 2 includes purchased electricity, steam, heating, and cooling. However, in the GHG protocol guidance, they actually just refer to all of those together as purchased electricity. They sort of define it that way. And so again, I just think it's an important reminder that it includes both. The other point then, Marcin, is that when we're thinking about purchased electricity, there can be a huge range in emissions depending on the source. So we'll get into that with scope 2, but I think it's important for people to know scope 2 is not just, take your power bill and you're done with it.
Yeah, and I think, Heather, the important element here is the whole word purchased, right? So we're talking about the electricity and companies purchasing. So for example, if your reporting entity has its own generation in backup generators or some small power plant within its operations, and although they're going to be using this electricity, emissions associated with this electricity are going to be classified as scope 1 because they self-generated. So it's a very important distinction between the purchased electricity and self-generated. Self-generated, we're going to report as scope 1. Purchased, we're going to report as a scope 2. So I think, and sometimes people get confused because it's electricity, right? But the understanding is whether this is purchased or self-generated is critical here because that's going to impact the classification when you're going to report those emissions.
All right. So then, Marcin, I know I jumped in there. You started talking about scope 3, but there's definitely more to say there. So again, we're going to have a separate episode, but to help level set, what else would you say now?
Well, so as I mentioned, scope 3, emissions, they sound a little bit mysterious, right? But when you think about the sources itself, as I mentioned before, those are the same sources. We talk about combustion, processing, unintentional, intentional releases. What is really important here is to understand your value chain. So when we're talking about the source scope 3, this is value chain of our company. And we distinguish this between upstream or downstream emissions. So emissions that are happening in your value chain upstream of a company or downstream, right? Specifically, we're talking about emissions associated with production of purchased goods and services that we're acquiring, or emissions associated with use of goods that we manufacture and sell, or services that we provide to customers, right? That happen downstream of us. So again, it's very important to think about what is the value chain and think about everything we buy or sell, every service or product. There's emissions associated with this during the manufacturing or provision of those goods or services, and we have to report those emissions that are being generated in our value chain.
All right, I think that's helpful. The other point I'd make on scope 3 versus scope 1 and scope 2, again, we'll get a little more into this, but by order of magnitude, for many companies, scope 3 is multiple order of magnitudes compared to scope 1 and 2. And in particular, I actually interviewed someone from Baker Hughes, and she was describing the fact that their scope 3 emissions are 97% of their total emissions. And so I feel like sometimes scope 3, to your point, people think it's a little mysterious. It seems difficult. It can be difficult, but it is obviously also very important and something that people need to focus on. All right. So you guys know how much I love a good pop quiz. And this is a topic when we were writing the chapter, the sustainability reporting guide, I think is probably one of the areas we got the most questions is understanding the differentiation between organizational boundaries and operational boundaries and why operational boundaries are important. And so, Marcin, maybe starting with you, if I have an organization and I've determined my organizational boundaries for this organization, why or how do I use operational boundaries?
Well, so I think it's a good question. I think Kelsey kind of touched up on this. It's now about the classification of emissions, right? So when you determine organizational boundary, as we said, you're first determining, the entity's operations and assets that, should be included essentially in your consolidation, right? So, but when you look at those entities' operations, they all have also value chain, right? So now the next important step is to distinguish, right? How are you going to classify those? Because I would call it universe of emissions, right? Which is within your organization and outside of your organization. Organizational boundary is going to set the limits what should be included for direct and indirect. And now key step in setting operational boundaries, how you classify those, right? Because it's really important for users of that information to really understand what is your direct, so scope 1 emissions, and what are your indirect emissions. Which is scope 2 and scope 3. So this is pretty, because you can influence those emissions differently. Remember, one of the elements of key elements of emissions reporting is to show the world to you how you manage, how you impact the reduction of emissions, and impacting reduction of your own direct scope 1 emissions versus indirect scope 2 and scope 3. Those are different ways you can do it, and readers of this information look at it differently. So this classification is really crucial. But organizational boundaries essentially determine your entire kind of a universe of what you should be reporting, in your emissions reporting.
I do think that's a good explanation. So good job, Marcin, gold star. I do think there's one key thing there, though, that we might need to emphasize a little more. I'm going to see if Kelsey is reading my mind, or otherwise I will chime in.
Yeah. So I think one of the key things there is just, within those entities, assets, and operations is really identifying the sources of emissions. And so maybe if you just take even a simpler example, like say that entity that's included in your organizational boundary, you just have one warehouse where you are generating something. So that whatever machines or something you're using to generate that product or service, that's going to generally be something in your scope 1, right? Because that is a direct emission you are generating. Then you can think about, well, how do I turn on the lights at that warehouse? I'm purchasing electricity. That's generally going to be in your scope 2. And then think about, well, what are the various miscellaneous pieces and parts that I need to purchase to make that machine generate my product? That might be in your purchase goods and services and your scope 3 emissions. So just a very simple example, just thinking about within that organizational boundary, what are those sources that generate emissions, and then how would I classify it?
Yeah, and I think a key point that you guys both touched on, Marcin, earlier when you were describing the various sources is really this idea that even that piece of machinery, there could be fugitive emissions. So it's not just the obvious, how I'm operating the machinery, but what other emissions may be created by those operations.
Well, and I think what is really, that's why I mentioned initially, people think scope 3 is mysterious. It is. Actually, I said it's not, but it is a little bit mysterious because think about this identification of sources. So as Kelsey said in her example, if you want to continue with that example. So we look in what parts or other equipment I'm purchasing from somebody. The equipment is being used by me, but then somebody else generated emissions when they created that equipment. So then now you have to be thinking, okay, what are the sources of that emissions during the production of this equipment, which is a little bit, I use the word mysterious, but the challenging because you didn't produce it. You don't know what type of, how they power their facilities. Is it electricity based? Is it kind of some other combustion? What other sources they have that impact the emission profile of the equipment that you bought and you're using in your own operation? So again, you were right. Or Kelsey's right. The magic word was identification of sources within your organization, but also within your value chain.
Yeah, and I think, again, maybe the other piece I would add here is Kelsey gave an example of one of those category 3s, but then you also could have the employees that are driving to work, and then you could have employees that are traveling salespeople, and then you could have the downstream use of your product.
Or transportation of when you bought it from third party, somebody has to deliver this to your warehouse. When you make your product, somebody bought it from you, there's a transportation that's going to deliver that product. If we start getting a little bit, more waste, right? When your product, is going to stop being used, somehow it's going to become a waste. So it has to be utilized somehow. Again, it all generates emissions. And when you're doing this identification of sources, especially within your value chain, you have to go through this step by step and think through what happens with your product from the gate of your factory or warehouse, as Kelsey said, all the way to the landfill, put it differently. And you have to be thinking about this during that journey. Each step generates emissions, and you have to identify what are those steps and what generates emissions during those steps. It's good we have a GHG protocol scope 3 standards because it helps you think through those steps, right? It was kind of a design in a way whereby it helps you think what are those standardized, let's call them standardized steps, and stops in this journey and where those emissions are being generated. And there are factors around it. So we're going to talk about this a little bit more, but that's why it's so important to fully understand that value chain and understand when these emissions are being generated, right?
Yeah, so if I can summarize then what you guys have just talked about, what we said is, okay, in our last episode, we've identified our organizational boundaries, and that can be quite extensive. There's lots of different entities that can be included there. And then once I have those entities, after I identify within the entity all of the different sources of emissions, which can be quite extensive. So when you start to think of a large company with a lot of different operations, this can become exponentially quite significant. And it's a data wrangling exercise that we will also talk about a bit. All right. So that's actually, Kelsey, a great example. And I think a perfect lead in to a question that we get quite a lot is that we were just talking about a case where you have an entity that owns a manufacturing facility. However, often you have an entity that is leasing the manufacturing facility. And I think then this raises a lot of questions about how you classify the emissions and whether those emissions should be scope 1, scope 2, or scope 3. So Kelsey, do you want to give us some high level and then we can dive in a bit?
Yeah, you're right, Heather. We do get a lot of questions on how do you account for the GHG emissions from leases. And this is often a challenging area because, leases are not owned, but are controlled by a lessee. And so it's like, which scope am I putting them in? And it kind of also falls in between a little bit organizational boundaries and operational boundaries. So, but really the classification of emissions from leased assets will really depend on, 1, what sustainability framework you're following, 2, how you define your organizational boundary, and 3, the interaction of those 2 items with the applicable accounting guidance. And so then for purposes of today's discussion, we'll highlight, how the GHG protocol indicates to account for emissions from leased assets and go through a number of other considerations. So to really address the question about how to account for emissions from leased assets, the GHG protocol has put forth a model that really tries to align the reporting of GHG emissions with financial accounting concepts. However, I will say that when they did this, they linked up the reporting of emissions with the accounting standards that were in place when the protocol was issued, which, if you can recall, that was ASC 840 and IAS 17, which are outdated standards as they were subsequently amended by ASC 842 and IFRS 16. And so the model set forth in the GHG protocol for emissions reporting from leased assets is really based on the definitions that were in place under those old standards, which was based on assets being on the balance sheet only for finance and capital leases and not on the balance sheet for operating leases. And so, following the guidance in the GHG protocol for reporting GHG emissions for leased assets is often challenging for users today who are reporting under current accounting standards.
Yeah, and Kelsey, maybe I'll jump in here before you go on. And just a reminder to our listeners that we are talking here about the GHG protocol, but this would also apply to reporting for purposes of California 253, which requires reporting in accordance with the GHG protocol, and then also for reporting under the ISSB standards or California 261. Both of those with an asterisk. And of course, we always have these asterisks, but this one is because they do permit use of the jurisdiction or standards for measurement standards from a jurisdiction or exchange. And so that, in some cases may impact this. But for today's purpose, we're going to talk about it without an asterisk. And we will separately talk about ESRS when we finish with this. So I think, Kelsey, you gave a great summary there. Basically, if I can make the long story short, we have a conflict right now between what is in the GHG protocol and then our current accounting standards. And we also have the fact that the GHG protocol went out of its way to say it wants to align emissions accounting with financial accounting. And so there's an inherent conflict there. And I know that we've looked at the definition of leases and the current accounting model. So Marcin, maybe you can jump in and explain how we can reconcile those views.
Yeah, so as Kelsey mentioned, the key for accounting for emissions from leased assets is your organizational boundary selected and financial reporting and accounting for leases. So maybe let me kind of, and as Kelsey mentioned, or you mentioned too, the standard was updated. But maybe let's start with the simplest scenario. So a scenario whereby our clients are reporting entities using operational control approach. That's a simple because it's consistent. It doesn't really matter all the new standard. In these situations, lessee is always presumed to have operational, or in most cases, presumed to have operational control of leased assets. Therefore, lessee reports Scope 1, Scope 2, and respective element of scope value chain emissions from leased assets. Then you reverse to lessor, because lessor is presumed not to have operational control. They're going to report all the emissions associated with leased assets as the value chain emissions in their Scope 3. So it's kind of that's the simplest. Where it starts getting challenging between old accounting standard, new accounting standards is financial control and equity method, because now there is some kind of the difference between how initially old standard worked versus how the new standard works. So for everybody to realize what really changed kind of holistically, or one of the key differences between old and new standards is under new accounting standards, because lessee, right, is presumed to have a control of leased asset during the term of the lease. This control it actually meets the definition of the asset. Therefore, lessees now under new standards ASC 842 and IFRS 16, lessee is recording right of use assets on its balance sheet, which under old standards it wasn't the case, especially for operating leases. So now, following the basic principle of GHG protocol, in our opinion, right, because this right of use asset is reflected on lessee's balance sheet always, We believe that under financial control and equity approach, lessees should also, report Scope 1, 2, and respective part of Scope 3 emissions of leased assets in all circumstances. So, long story short, from lessee perspective, there's no difference in our opinion what kind of a control approach they're using, organization boundary they're using, and what type of leases they have. So lessee should be reporting emissions associated with lease assets. So now,
and Marcin, maybe you've forgotten, that's reflecting two things. One is the fact that the lessee has operational control, and then two, otherwise reflecting the right of use asset that the lessee has on the books. That results in the accounting that you just talked about. But then let's go to lessor and what this means from a lessor perspective.
So lessor kind of situation is a little bit more complicated from that perspective if you want to follow this model, because lessor can reflect leased assets on its balance sheet in two different ways. One, in certain arrangements, lessor can still record the fixed asset, physical assets on its books that's being depreciated like any other PP&E or fixed assets. Or in other scenarios, lessors can be reflecting the lease receivable, which is not your fixed assets. It's kind of a financial assets, lease receivable on these books. And in our opinion, that drives the accounting for emissions from those assets. So in circumstances where lessor is reflecting physical assets, we believe it should report Scope 1, 2, and respective part of Scope 3 emissions in its emissions reporting. But in situation when they only reflect the leased receivable, right? Those all emissions from lease assets should be reflected in Scope 3, like similar, like you treat it like, financed emission or something like that.
And Marcin, to be clear, then that is under equity share or
financial control.
So if I can summarize here quickly, that under equity share and financial control, if you are the lessor and still recording the physical asset, you would actually still record Scope 1, Scope 2, and your respective share Scope 3. If you are reflecting it as this finance receivable, then you would treat it as another type of financial asset, and you would be reflecting the Scope 3.
Yes, that's correct.
All right. But then if I'm under operational control, then I would just look at all of them as being Scope 3 because I do not have, as the lessor, I do not have operational control of the asset. Okay. So I think, this aligns with, as Kelsey said at the very beginning, the point in the GHG protocol that they make very strongly is that there should be linkage between accounting for leases and emissions reporting for leases. And so, our interpretation is that what we've just described lines up. From a lessee perspective, I know there may be other views. So how do we think about that?
Obviously, when you look at the companies might follow what's specifically written in GHG protocol right now. So that's also would be acceptable view. However, obviously, companies are going to have certain challenges because the GHG protocol distinguishes between different type of leases, operational, operating lease, capital or finance lease, and some of these updated standards do not distinguish those. So that's going to be challenging, but obviously that's one of the ways companies could go and apply that. It's also very important for certain jurisdictions where lease standards were not updated, right? Because obviously I'm not claiming I know every single jurisdiction in the world, but we know of certain jurisdictions whereby the accounting standards were not updated and those jurisdictions still use the old accounting for leases. So this is where existing guidance in GHG protocol may be very helpful because it reconciles with these old models. But the main message here is whichever jurisdiction or financial reporting for leases you are applying, in each case, reporting entities who have to really consider, how to reconcile what's the current accounting in the financial reporting and how to reconcile this with requirements of GHG protocol and or some other reporting frameworks.
All right, I think that's helpful. And I do think for our listeners that want to know more, they can definitely check out the discussion in our sustainability reporting guide. I also think, to be clear, one of the questions we've gotten is whether this interpretation that we've discussed we would view as in compliance with the GHG protocol. And we definitely would, because the fact that it's alignment with it is aligned with the principles there. But to Marcin, to your point, there are potentially other views. Now, that was talking about GHG protocol and the related frameworks I mentioned. There's different rules for ESRS. So what can we explain there?
Yeah, different. Yeah, I think there are different rules. So I think the main difference is ESRS has a different approach to organization and boundary, right? So if we remember from our, it seems like a remote now, our kind of, I think part 2, right, was it? ESRS has this additive kind of approach to setting organization boundary. So the first, it considers consolidated accounting group, so the assets included in consolidated accounting group, and then has a second step is considering, all unconsolidated entities, assets, and operations, whereby the operational control has to be applied. So when you think, about the first step, the first you consider emissions from consolidated accounting group, so all the assets and operations recorded in your balance sheet. So that reconciles with our proposed approach for updated accounting standards because, let's look at lessees, right? So for all lessees, right of use asset is reflected on their balance sheet. So therefore, you fall into this first step. So you should be reporting emissions associated with all the assets in your consolidated group. Right of use assets is one of those assets, so you should report emissions from those assets, irrespective of type of leases or accounting guidance that you're following. If you have right of use assets, you should report the emissions from these assets. And then when you look at lessors, similar to what we just talked before, you can have 2 scenarios. Lessors are going to have either physical assets on the books or financial assets. Let's refer to it lease receivable. So if you have physical assets, you're going to report emissions associated with these physical assets as a scope 1, 2, and respective part of scope 3. If you have a AR or lease receivable, you're going to report all the emissions from these leased assets as a scope 3 emissions.
Well, and I think key there for both of those, lessor and lessee, is the fact that you don't have the same issue with are you using the operational control approach, financial control or equity share. You are just following this guidance, as you said, and that answers your question for lessee and lessor under IFRS and US GAAP. But Marcin, how about those local GAAP reporters?
Well, again, the principle stays the same depending what your local GAAP tells you. What you're looking at is, do you have assets on your books or not? And what type of assets you have recorded on your balance sheet.
So then, Marcin, I think that's helpful. And in some ways, I think more straightforward for companies than what we just were talking about for the GHG protocol. I do think there's one point here that I know listeners are going to ask the question, which is, what about local GAAP? And so it's interesting for local GAAP, if we think about the lessee under local GAAP, in some cases, they may not have an asset recognized on their balance sheet, in which case you might be thinking, oh, well, then I don't have to reflect the scope 1, scope 2, and respective share scope 3 emissions. However, I might remind people that if they listen to our prior episode, that you have this 2-step approach for determining organizational boundary. You start with financial control, and then you add in assets, entities, operations over which you have operational control. So in this particular case, then, even if it's not on your balance sheet, you would need to go to step 2, say, well, do I have operational control? And since it's a leased asset, inherently, the lessee does have operational control, so they would need to report it as scope 1, scope 2, and respective share of scope 3. And then the lessor would follow the same model, basically, we talked about for ESRS, where basically you would recognize emissions of scope 1 and 2, where you have the lease asset on your books. And if it's a finance lease receivable, then you would look to scope 3.
Which is it's a very good point, Heather. I think you caught it. So we're ending up in the same spot, but we're just getting
a
in
different way.
Yeah.
That's a great point.
Yeah.
Yes. So under ESRS, irrespective of your accounting model, you're going to come to the same answer.
Yeah.
All right.
Just slightly differently.
Slightly differently. So I definitely would encourage people to check out our guide if they need more information. Okay, we've talked about a lot. I think the first section was really reminding people quite a bit about the different meanings of what's included in scope 1, scope 2, and scope 3. And then obviously, as Kelsey reminded us, the importance of making sure you identify all the sources of your emissions, because if you don't get that step right, well, all these steps, if you don't get something right, your emissions are not going to be correct. But again, I think this identification of sources in talking to people who are involved in reporting emissions, this is one of the places that additional sources are often subsequently identified. So it's very crucial there. And then secondly, for leasing, you really need to make sure you understand which framework you're reporting under, whether you're the lessor, whether you're the lessee, and then the intersection of the accounting emissions. So that's my reminder. However, you guys may have some more practical reminders to give. So maybe, Kelsey, I'll go to you first. If someone's dealing with operational boundaries, what should they be thinking about?
Yeah, I think when it comes to determining operational boundaries, just go back to the basics. So, maybe at the beginning of our conversation is, what are those emissions that are being generated by you, the reporting entity, or are they being indirectly generated by you, maybe on your behalf? That's really like the starting point of trying to think about, once you've identified these sources, like how to classify them as direct or indirect. And then I'll just reiterate what you said on leases. Just leases takes a little bit of time, careful evaluation of your leases.
So I do slightly different, different take on it. I think I keep repeating this quite often. You need to know your organization. You need to know your organization, like what you do within your walls, but also what is your value chain. Because in this step is going to be really crucial. This discussions we had about identifying sources of emission. When you think about it, it's about knowledge. And in practical, example, when we work with a client, trying to go through a process of identifying all the sources of emissions within their kind of walls, put it that way, and in the value chain, it's a lengthy process. You really have to talk to multiple people within an organization. Oftentimes we do, like good old auditing days, site inspections. So you go and look at, where do you have potential sources of emissions, when we talk about scope 1, and then working and talking to people across organization, purchasing, different departments, just to map their value chain, to understand, to be able to identify those sources of emissions. The same applies to leases. You need to know your organization, what type of arrangements they have. So that's the crucial part that will require, for those who are going to be new to emissions reporting, would require really involvement of multiple people from their organizations to get it right.
Well, and I think, Marcin, maybe I'll just add on there, even if you aren't new to emissions reporting, I think this period of transition from voluntary reporting to regulatory reporting is the ideal time to reassess and make sure that you have identified all these sources, that you've gotten your organizational boundaries right. And to Kelsey's point, that you really think about your lease accounting. Yep. So, all right. Well, Marcin and Kelsey, as always, such a pleasure to talk to you. Thanks so much for joining me today.
Thank you, Heather.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.